Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamoan, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions.
This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're diving into the latest report from the Toronto Regional Real Estate Board, which has revealed some significant shifts in the Greater Toronto Area's housing market. Steve, it looks like we've seen quite a drop in home sales this March.
Absolutely, Janine. The report shows that home sales in Toronto have dropped by 23.1% compared to last year. That's a substantial decrease, with only 5,011 homes sold in March. This decline is quite stark, especially when we see that most of these sales were in the detached home segment, which was down by 24.9%.
It's concerning, Steve, especially when you think about how many people are affected by these numbers. The drop in condo apartment sales by 23.5% and townhouse sales by 23.2% also indicates a broader market slowdown. Do you think this is linked to the recent economic uncertainties?
I think it definitely plays a role, Janine. The Bank of Canada has lowered its policy rate significantly, which you would expect to stimulate the market. However, ongoing trade issues and tariffs are creating a lot of uncertainty. People are hesitant to make large financial commitments when they're unsure about their job security and the economy.
That's a good point, Steve. With new listings surging by 28.6% year over year, it seems like there's a lot of inventory available. But with the average selling price at $1,093,254, even with a 2% decrease month over month, affordability is still a major concern for many potential buyers.
Exactly, Janine. CHAR-EB President Alekia Berry-Sproul mentioned that while home ownership has become slightly more affordable due to lower borrowing costs, the market is still waiting for a boost in consumer confidence. Buyers need to feel secure in their employment before they're willing to commit to a mortgage.
It's a delicate balance, isn't it? CHAR-EB's Chief Information Officer, Jason Mercer, emphasized that resolving trade issues could help improve the situation. If policies are adjusted to mitigate the impact of tariffs, we might see an increase in home sales. But until then, it seems like buyers are cautious.
Indeed, Janine. TREB's forecast for this year suggests a well-supplied market, which could keep home prices in check and provide buyers with more negotiating power. However, with the prediction of around 76,000 transactions by the end of the year, it will be interesting to see how things unfold compared to the peak of 120,000 transactions in 2021.
So, Steve, it seems like the Greater Toronto Area is experiencing quite a shakeup in its real estate market. According to the Toronto Regional Real Estate Board, home sales have fallen by 23.1% in March compared to last year. That's quite a significant drop, isn't it?
It definitely is, Janine. With only 5,011 homes sold last month compared to 6,519 in March 2024, it's clear that the market is facing some challenges. The decline is not just from last year. Sales were also down 2.4% from February on a seasonally adjusted basis. This is happening while the number of new listings has surged by 28.6% compared to last year, indicating an increase in supply.
And yet, despite the increase in listings, the market seems to be cooling off. TREB's Chief Information Officer, Jason Mercer, mentioned that many potential buyers are taking a wait-and-see approach due to economic uncertainties, especially with ongoing trade issues and a federal election campaign looming. Do you think this hesitation will continue?
It's likely, Janine. When people are unsure about the economic climate, especially with factors like trade uncertainties, it affects their willingness to make long-term commitments, like buying a home. While Canada has avoided some widespread U.S. tariffs, Industries like steel and aluminum are still facing 25% tariffs. Plus, the auto sector isn't spared either, which adds to the uncertainty. Until there's more clarity, we might continue to see this cautious approach from buyers.
TRRE President Alekia Berry-Spruill did express some optimism, though. She mentioned that homeownership has become more affordable over the past year and expects further rate cuts this spring. This could potentially boost consumer confidence and sales, right?
True, Janine. Lower borrowing costs can make homeownership more accessible, and with more properties available, buyers have greater negotiating power. The average selling price in March decreased by 2.5% compared to last year, which could be appealing to potential buyers. However, the key is consumer confidence, and that relies heavily on job security and economic stability.
It's a complex situation for sure. In the city of Toronto, sales dropped by 16.9%, and in the rest of the Greater Toronto Area, they fell by 26.5%. All property types saw fewer sales, with detached homes, condos, and townhouses all seeing significant declines. It really underscores the breadth of the market slowdown.
Yes, and it's interesting to note that the composite benchmark price, which represents the typical home, was down 3.8% year over year. This suggests that while prices are softening, the market is still adjusting to these economic pressures. We'll have to watch closely to see how policy changes and economic developments influence the market moving forward.
Steve, the Toronto real estate market is currently facing a lot of pressure due to various economic uncertainties and an upcoming snap election. The Toronto Regional Real Estate Board reported a decline in home sales by 2.4% in March, following a significant drop of 28.5% in February. This trend is quite concerning, particularly for such a large city.
Absolutely, Janine. The numbers don't lie. We're seeing a persistent downward trend in home sales, and it's reflective of broader economic pressures. The home price index has also been on a decline for 3 consecutive months, reaching 1,050,200 Canadian dollars. The snap election and new United States trade tariffs are only adding to the uncertainty.
And while there was a 9.6% rebound in new listings, the market is still struggling. Year-over-year sales are down by 23.1%, and the price index has decreased by 3.8%. It's a challenging environment for both buyers and sellers. What do you think is driving this hesitation among potential buyers?
I think it's a combination of factors, Janine. The ongoing trade tensions, particularly with the United States imposing a 10% baseline tariff, are creating a lot of uncertainty. Investors and prospective buyers are being cautious, waiting to see how these economic conditions play out. The interconnectedness of global trade policies and local economies can't be ignored, and it's affecting buyer confidence.
It's definitely a ripple effect we're witnessing. The upcoming snap election on April 28th, orchestrated by Canadian Prime Minister Mark Carney, is also contributing to this climate of uncertainty. Political changes can have significant implications for policy and international trade relations, which in turn impact the real estate market.
Yes, and the Toronto real estate slowdown is a direct result of these uncertainties. It highlights the potential opportunities or pitfalls for investors, depending on the election outcomes. The market reaction is a testament to how global economic shifts can influence local real estate dynamics.
It's a complex situation, Steve. The economic crossroads Toronto is facing could lead to significant changes in the political and economic landscape of Canada. We'll have to keep a close eye on how these developments unfold and what it means for the real estate market moving forward.
Let's dive into the surge we've been seeing in CMHC-insured multi-unit lending. The recent report by Morningstar DBRS highlights a significant increase in the volume of these loans, jumping nearly 75% in the first 9 months of 2024 compared to 2021. This is despite a more modest 20% increase in purpose-built rental starts over the same period. What do you make of this, Janine?
It's fascinating, Steve. The introduction of CMHC's MLI Select program in 2022 seems to have played a crucial role here. By offering developers more favorable loan terms for projects that meet affordability, energy efficiency, and accessibility benchmarks, it's really incentivized the market.
Absolutely, Janine. CMHC's mortgage insurance allows lenders to offer lower interest rates, longer amortizations, and higher loan-to-value ratios than they would with uninsured financing. This structure has opened the door for smaller and mid-sized lenders to play a larger role, which is quite significant.
And it's remarkable to see how active these mid-sized lenders have become. Equitable Bank, for example, held the largest share among all issuers, with a 175% increase in insured multi-unit residential mortgages under management since 2021. This is a testament to how government-backed securitization funding has enabled these lenders to compete effectively with the big six banks.
That's right, Janine. The lower credit risk associated with insured loans makes the multi-unit segment particularly attractive to a broader range of lenders. However, it's important to note that while the structural demand for rentals remains strong, recent market shifts could put pressure on near-term development activity.
Yes, the report points out that softening rents towards the end of 2024, record completions of rental and condo units, and more restrictive immigration policies could impact the market. Additionally, CMHC has introduced stricter underwriting criteria, which might slow things down a bit.
Indeed, Janine. Despite these short-term pressures, the report maintains a positive medium to long-term outlook for CMHC-insured multi-unit financing. With condo starts down 18% year over year in 2024, developers are increasingly turning to purpose-built rentals, where starts rose 12% in the same period.
It's clear that government support remains robust. The expansion of securitization limits in 2023 to accommodate more multi-unit lending and the continued purchase of a portion of CMHC's Canada mortgage bond issuance by federal agencies are keeping funding costs low. This support is crucial for developers relying on insured lending to fund their projects.
Absolutely, Janine. The report concludes that insured lending will continue to be a significant funding source for multi-unit projects. This development is a key indicator of how the lending landscape is evolving, with more players entering the field and adapting to market conditions.
Steve, it looks like Canada's merchandise trade balance has taken a hit. According to Statistics Canada, we've swung back into a trade deficit of 1.5 billion Canadian dollars in February. This is quite a shift from the $3.1 billion surplus we saw in January. What do you think is driving this change?
Well, Janine, the drop is largely due to a 5.5% decrease in exports, which fell across 10 of 11 product categories. This includes significant declines in key areas like autos, energy, metals, and lumber. It's interesting to note that this follows a 15.9% surge in exports between September and January, as Canadian companies rushed to ship goods ahead of impending U.S. tariffs.
It's definitely a complex situation. CIBC economist Catherine Judge pointed out that this front-running effect reversed sharply in February. U.S. businesses had built up enough inventory in the previous months, which has put pressure on our exports now. It's a reminder of how interconnected our economies are, isn't it?
Absolutely, Janine. The impact of tariffs and trade policies is significant. Energy exports fell 6.3%, and auto exports were down 8.8%, with a notable 15.3% drop in passenger cars and light trucks. These are stark numbers, especially since nearly all these vehicles were shipped to the U.S. The ongoing trade tensions are clearly affecting our export performance.
And it's not just the U.S. We're seeing changes with exports to countries other than the U.S. fell by 12.4%. with declines to major markets like the United Kingdom and Germany. Meanwhile, imports rose slightly by 0.8%, showing that while we're buying more, we're not selling as much. This imbalance can be concerning for our economy.
That's right, Janine. Our trade surplus with the U.S. narrowed significantly, and our deficit with other countries widened to a record $12.1 billion. Catherine Judge also warned that while we avoided reciprocal tariffs on U.S. imports, The higher effective tariff rate on U.S. imports overall will slow U.S. and global growth, impacting our exports further.
It's a challenging outlook, Steve. BMO's Benjamin Wrightsey anticipates that the impact of these tariffs will intensify in the coming months, particularly affecting sectors like steel, aluminum, and autos. As firms adjust to the new tariff regime, we might see some volatility in trade data. It's a reminder of how quickly things can change in the global market.
Indeed, Janine. With the U.S. imposing tariffs and other sectors working to meet USMCA rules, we're in for some turbulent times. But as always, we'll keep a close eye on these developments to understand their implications for the real estate and mortgage sectors here in Ontario. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder, Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals.